Is the fourth consecutive increase in CEO optimism a harbinger for the growth cycle in 2025? I'm Joe Galvin, Chief Research Officer for Vistage, here to share the results and the analysis from the Q1 Vistage CEO Confidence Index. Our latest quarterly survey captured sentiment from over 1,700 CEOs in early March, and the results show that economic optimism continues to grow. Over the next 10 minutes, we're going to explore the top trends that will help inform your decision-making in the near and the long term. The Q1 2024 Vistage CEO Confidence Index rose nearly 4 points from Q4 to 85.9. This is the fourth consecutive quarter of increase, with the index reaching its highest level in nearly 2 years. At the same time, it remains as low as the lowest scores from the rising tide decade of 2010. With inflation moderating, the Fed holding off on interest rate cuts, at least so far this year, and it's still a highly competitive and costly job market, there are many factors impacting business today. Most interesting is while the perceptions about the economy rose, hiring has slowed to record low levels. Just 51% plan to increase headcount in the year ahead. The composite score for hiring is the lowest score since Q4 of 2012, except for those pandemic years. And suddenly, 10% are planning to reduce personnel. Now, this may be through natural attrition versus layoffs, but it suggests a still slowing job market. With all these factors in play, we need to turn to an expert to get a real perspective on what's going on. And that's why we turn to ITR Economics and their VP of Economics, Jackie Greene. Welcome back, Jackie. It's so great to be back with you and have you help us connect the dots between the index, what our CEOs think, and the trends and forecasts from ITR Economics.
Thanks for having me.
Well, great. So, Jackie, what are your thoughts on the index and how that connects to your economic analysis?
Some of the key things I saw with the index was that rate of change is a highly scientific term here, skyrocketing, right? It's going very quickly up, which is normally a signal for a reversal in the U.S. industrial production trend, which would mean we'd be hitting that recovery and some nice growth coming ahead. But as you mentioned, it's a very low level that the actual numbers are coming from. So while we have that rate of change reversal, we have to put it into a little perspective about how low that low really is in terms of where that activity is coming from. So that's one of the things we're watching very closely, is not just looking at the leading indicator on a rate of change basis, but what's the big picture? And how that factors out is you need to be very aware of how you fit into the economy. You can't just read every headline and say the economy is doing this, so you should be doing something. If we break it down into three major ways of looking at things, just to highlight some of the differences. U.S. industrial production is contracting, and we expect recession in 2024. GDP growing at a slowing rate right now, but we do expect a quarter of contraction in 2024. Whereas services, they're going to be growing throughout 2024. So there are three different ways you can look at the economy, and there's many more, but they all have varying trends to be aware of for 2024.
That's interesting because it speaks to the need to be aware of where you are in your cycle, in your industry and market. The Fed met recently and determined they're not ready to reduce interest rates just yet. Planned investments in our study held steady despite the relatively high cost of money. As interest rates remain high and shed the possibility of maybe slowing in the future, how does that cost of money and how does that affect how CEOs should be thinking about their investments?
They need to be thinking about it in many different ways. One of the things in the survey was that cash holdings were relatively up. And the question is, why? Why are you holding extra cash right now? What do you intend to do with it? If it's so that you can make a future purchase, you're saving up the money instead of using the higher interest rates now, you really need to think through, is it worth the wait? Do a spreadsheet analysis about if you wait that extra year, what gain would you have had now if you did the purchase now instead of for the lower interest rates a year from now? You need to factor in how long it takes to get whatever resource up and running, whether that's a person you're hiring, whether it's a new piece of equipment or machinery. How long does it take to actually get that resource into your business? And even then, how long does it take to train them up? So if you figure you're waiting a year to make this purchase or this investment, we're talking 2024. If it then takes you a whole nother year to get that in, and then that piece or people trained up, We're talking 2026. So if that's the case, how much time have you lost where you could have been doing something sooner? And now at 2026, you're closer to the 2030 benchmark that we've always been talking about, and you've shortened your runway for gains. So is it really worth waiting on that little change in the interest rate? And you need to factor in too, is this doing the same thing you've always done? Or is this something you're trying to do different to get you set up so that you're in a better space for 2030? Are you diversifying into a market that's going to be more recession-proof? So there's multiple pieces you need to be thinking about, and that's why it's that little spreadsheet exercise for everyone to be doing.
Jackie, our members shared that labor is the biggest cost impacted by inflation, while other costs are rising at a slower pace. Is 3.2% the now normal for inflation? Or will this hopefully fall some more? Or where are we going to fall in the inflation?
In terms of inflation, you can expect that to peter down in 2024 to like a high ones or low 2% range for the end of this year. But then it will go back up into the threes for 2025. So expect that little brief reprieve, later this year, higher next year, and get used to that higher 3 as a fairly normal state of things. Remember, we are expecting higher inflation as the decade goes on.
That becomes the now normal that we live in.
Exactly.
So, Jackie, if the cost of labor has the biggest impact on inflation, we discussed that, and we're seeing hiring slowing, what does that tell you?
It tells me that as business owners, we have a little bit more leverage when we're hiring, but it's still not all favorable. In 2023, there were periods when it was a 2-to-1 ratio. So for every 2 job openings, there was 1 person seeking a job. Now that ratio has shifted to about a 3-to-2. So for every 3 job openings, 2 people looking for a job. So still not the most favorable for the hiring party. And that's just the numbers. That's ignoring the skills gap. That's ignoring the location factor. So it is still going to be some upward pressure on wages. And it's going to be a tight labor market, or at least relatively tight, through the rest of this decade. So expect some general upward pressure on wages throughout the decade. I'm not saying it's going to be like it was in 2021, 2022, when we saw such extreme pressure, but don't expect that to dissipate or go away during the next few years.
It's certainly not going to get easier, that's for sure.
Oh, no.
Jackie, finally, can you put all this together and share with us, connect the dots? What does it suggest that CEOs should do and be thinking about for the balance of 2024 to prepare for growth and the growth cycle that we think is going to come in 2025 and beyond?
So what you need to really have in your mind is, we just talked about how the economy has different pieces moving at different times in different places. You need to know, how are you controlling your own fate? Right? So even if the economy is contracting or growing, you still have control of your profitability. Some of the data that was in the survey showed that those businesses that were seeing higher profitability, they were cutting back on expenses. Others who were showing that they had reduced profitability, a lot of it was because they were absorbing expenses instead of passing those things through. So you got to ask yourself, which camp are you in? And are you in the camp you want to be in? If you're not in the category you want to be in, what can you do about it? You're sitting there with your Vistage group. You have access to all these great people, great minds, resources. Think through different options you can take so that you have a better handle on your profitability in 24, in 25, and through the rest of this decade.
Well, Jackie, thank you so much for your insight and your time. We'll look forward to speaking with you again when we do the Q2 2024 Confidence Index survey analysis. Your guidance and analysis will help leaders of small and mid-sized businesses to better understand what to expect for the coming months and how they might adjust their strategies to navigate this uncertain economy. So, Jackie, thank you so much for being with us today. I'm Joe Galvin, Chief Research Officer for Vistage, thanking you for your time and look forward to sharing more research and insight with you as we look ahead. Thank you.